So, are you an Australian investor feeling that squeeze from low returns at home? You're not alone. Today, we are going to unlock the Dubai property market for you. We'll break down three distinct financing paths that can make a high yield international investment a real possibility. Let's dive in.
Okay, let's just get right to the heart of it. This chart says it all, doesn't it? It's the yield gap. In Sydney, you're looking at a gross rental yield of maybe 3.5, 4.5% if you're lucky. Now look at Dubai. We're talking 6 to 9%. Consistently. This difference right here is exactly why so many savvy investors are starting to look overseas.
And, this isn't just a small difference. Some are even calling it a yield compression crisis. It just means investors back in Australia are seeing their returns get squeezed tighter and tighter, which forces you to find smarter, more efficient ways to make your capital work harder. But hang on, it's not just about the yield. That's only half the story. Look at the entry price. A prime property in Dubai starts around 760,000 Aussie dollars. Now compare that to a whopping 2.8 million in Sydney or 1.5 million in Melbourne. You're paying way, way less for an asset that's actually going to produce a lot more income. It's a pretty compelling argument. So we've laid out the problem, right? Low yields, high prices at home. Now let's turn to the alternative. Dubai really does present a powerful business case for Australian investors to start looking beyond their own backyard. And believe it or not, the high yields are just the beginning. In the UAE, there's no capital gains tax, there's no annual property tax, and your rental income, totally tax-free, at least locally. Plus, the currency, the dirham, is pegged to the US dollar, which gives you this extra layer of stability.
I love this quote because it just makes it so real. We're not talking about abstract numbers anymore. We're talking about trading a standard suburban unit in Australia for a premium, top-tier property in a global destination like downtown Dubai. When you put it like that, the value is just undeniable. Okay, but we have to pump the brakes for a second. This is a critical warning. It's super important. While you pay zero tax in Dubai, you are still an Australian tax resident. That means you absolutely must declare that worldwide income to the ATO. And here's the kicker. Because you didn't pay any tax in Dubai, you don't get a foreign tax offset. So that rental income will be taxed at your full Australian marginal rate. You have to factor that in. All right, now for the part you've been waiting for. How do you actually pay for one of these properties? Let's get into the core of this explainer and break down what can seem complicated into a really clear blueprint. There are three main paths you can take.
So here are your options. Path 1 is a traditional mortgage from a bank in the UAE. Path 2 is an interest-free payment plan that you get directly from a developer. And Path 3 is using the money you already have tied up in your Australian property through an equity release. Let's dig into each one. First up, the non-resident mortgage. This is probably the most conventional way you'd think of doing it. But just a heads up, the banks in the UAE see non-residents as a higher risk, so you've got to be prepared for much stricter terms than what you're probably used to back home. And here it is. This is the single biggest hurdle with this route. The UAE Central Bank puts a hard cap on mortgages for non-residents. You can only borrow a maximum of 60% of the property's value. That means you, yes you, are on the hook for a minimum 40% down payment, in cash, and that's before all the fees. It's a huge capital outlay. So here are the key details you need to know. Interest rates are sitting around 5 to 6.5%. The big lenders are folks like HSBC and Emirates NBD. But look at that approval time, 8 to 10 weeks. That's a long time to wait. So the most important takeaway here is this: get pre-approved before you even start seriously looking at properties. Okay, so if that whole bank process sounds a bit painful, path number 2 is a super popular alternative, especially if you're buying off-plan. With a developer payment plan, you get to completely bypass the banks, all that intense paperwork, and, best of all, the interest charges. So, how does this work? Well, it's often called a post-handover payment plan. And it's basically what it sounds like, an interest-free loan straight from the developer. You pay a certain amount while the property is being built, and then the rest, often as much as 40%, is paid off in installments over a few years after they hand you the keys. That means you can have a tenant in there paying you rent while you're still paying it off. Now, here's a great little insider tip. A word of caution, really. You'll see some developers advertising these amazing 1% per month payment plans. They sound incredible for your cash flow, but you've got to be careful. Sometimes the total price of the property is a bit inflated to make up for those generous financing terms. So always, always compare the final price. All right, let's move on to our third, and for many established investors, the most strategic path of all:
releasing the equity from your property in Australia. This can be the fastest and most powerful way to get into the Dubai market.
And the reason why is pretty simple. It all comes down to speed. Refinancing your home in Australia to pull out that equity takes about 3 to 4 weeks. Compare that to the 8, 10, maybe even more weeks for a Dubai mortgage approval. In a fast-moving market, that time difference is a massive advantage. When you use your Australian equity, you show up in Dubai as a cash buyer. And trust me, that status is like a superpower. You immediately have more negotiation power. We're talking potential discounts of 2 to 5%. You totally sidestep all the mortgage delays, and you're agile enough to pounce on those time-sensitive distress deals that other buyers just can't catch.
Okay, so we've covered the ways to get the money. But now for a quick reality check. The purchase price and the deposit, that's just the start. There are a bunch of mandatory upfront fees that you have to pay in cash.
This table breaks it all down. The biggest one, by far, is the Dubai Land Department transfer fee that's a flat 4% of the purchase price. Then you've got your agent's commission, some trustees' fees, and if you do get a mortgage, a registration fee for that too. All in all, these costs can add up to another 6 or 7% of the property's value, and you cannot roll them into your loan. It's all cash. So what does that look like in real dollars? Well, for a pretty standard 2 million dirham property, you would need roughly 395,000 Australian dollars in cash ready to go. That covers your 40% deposit and all those fees we just talked about. This number really drives home the kind of liquidity you need for this type of investment. And finally, the paperwork. The UAE's Know Your Customer rules are really strict. You'll need your passport, obviously, but you'll also need 6 months of original bank stamp statements. And I mean physically stamped, not just a printout. You'll need proof of income and a copy of your Australian credit file. Having all this ready to go from the start is absolutely non-negotiable. So after breaking down the incredible yields, the tax benefits, and those 3 clear financing paths, it really all boils down to this one question. For many of you watching, there's a significant amount of equity just sitting there, dormant, in your Australian home. The real question this whole explainer poses is, isn't it time to put that capital to work in a market where it can do so much more?